Fine. What it says, what we are doing here. See, when we do the process as such, is it right? When we are doing the process as such, is it right? Today is 9th, okay? Today is 9th. There are so many accounting standards, is it right? Till now, which we have done? We have done something with respect to IAS 16. We have done something with respect to IAS 40, investment property. We have done something with respect to IAS 38, impairment, the intangible assets. We have done something IAS 36, is it right? Impairment, is it right? IAS 36, 38, yes. And which one we have done? We have done IAS 20, is it right? Borrowing cost. We have done IAS 23, government grants, is it right? These are the few of the standards we have done. Fine, international. Now, apart from that, it's very small lecture. Apart from that, there are other standards also. What we are doing, see, they say that there is one standard. What happens? International Accounting Standard 8. Is that comparability? Is that we always make a comparison? See, there is no hard and fast rule that we have to do the things. Sometimes what will happen? There will be some changes. Is it right? There will be some corrections. Is it right? There will be some changes. There will be some corrections. There will be some changes and correction. That's all. Okay. There will be some changes in the policies also of the management. Definitely, that will be there. In that case, what we have to do? We have to prepare restated financial statement. When you are preparing restated financial statement, there is a small condition attached to it. We cannot go back. Is it right? We cannot go. Any changes are there. We have to take like this. Is that we have to do it in the current year, is it right? Or we have to change the policy from the next year onwards. Because why we should not do? We cannot do because it is almost we almost audited accounts. Is it right? Now, then it happens because of so many factors. One of the factors is the factors related to the prices. Prices will increase, prices will decrease. Most of the time, prices will increase. When the price is increasing, there is a dilemma that what we have to do. In that case, they say that there is one standard which is going to be stated, that is reporting standard IFRS 13. This talks about fair value. Is it? This talks about the fair value. Is it? What is the fair value? Definitely, we should come to a conclusion that this value is going to make some impact. Is it? That is the reason we are talking in terms of value. What we are doing here, we will where the values will increase. The prices will increase in so many cases. Is it right? Prices will increase, especially the prices will increase where the prices will increase with respect to inventory. Okay. Now, we have to be very careful whenever we are talking in terms of inventory. What the inventory says, it is IAS 2. They say that it is the lower cost or net realizable value. Again, if you take into lower cost, there are three different methods. Is it right? You have understood LIFO, FIFO, average cost, all those things. Is it right? Those are things which we will consider. International Accounting Standard 8 says that accounting policies changes in accounting estimates. Is it right? You are changing the estimates. Where there will be changes in estimates in terms of what? Changes in the selection of the policies. What is the policies we are saying? It is a depreciation. Is it? Take example. Depreciation. You are changing from straight line method to return down value method. Is that you are talking, or you are talking about the life of the asset. Initially you will say the life of the asset is 10 years. Then after 4 years, is it right? After 4 years, you will revise the life. Is it right? You have the option. Is it right? You have the revise the life. You will say that it is not 10 years. The remaining life is going to be how much? It is only going to be only 3 years. Then immediately you have to look into those factors. Now, selection of the policies and changes in the policy. The moment you are changes in the policies, what will happen? Your estimates will also change. Is it right? The moment you are changing the depreciation, is it? You are changing the depreciation method. What will happen? Automatically, the estimates will also change. Is that it's not a small activity. It's a big activity which is linked from one case to another case. Fine. Now, when we are having the changes in estimates, definitely what will happen? You have to have a correction of period errors. Sometimes what will happen? You will have some mistakes will be there. Is it right? See, the rule says, general rule, ACCA rule says that we have to take into consideration last 7 years. But it is not that we should not take that advantage. Okay? We should not take that one. Corrections can be made. If you take taxation also, what taxation rule says in general that you can make correction for the last 4 years. Anything plus or minus during the last 4 years, you can revise and you can pay the tax or you can refund the tax. Is it right? This is what we are talking about. What are the various topics? We are talking about the policies, selection of policies, changes in the accounting policies, changes in the estimates, and subsequently any corrections are there in terms of errors. Is it? Now, when you are talking about the policies, how the policies will work, is it right? They are the principles, basis, is the rules and regulations. Is that what are the policies? When you are talking about the principles in terms of what? Principles in terms of conservatism. Is it right? Principles in terms of always make it a point that you cannot be aggressive. Okay? Means while estimating the things, you have to be very cautious. Whenever we make a point that I'm estimating, is that don't project beyond the things. Projection should be low, actual should be more. Is it right? You project, this is what it says. You project profit. Is it right? Project profit as projected profit will be how much? Assume projected profit will be 50,000. This is what we are making an estimate. Is that? But actual profit should be more than 50,000. It should not be less than 50,000. Is it right? Then automatically your projections will be little bit more reliable. Is it right? So never project on the higher side. Project on the lower side. Show the actuals on the higher side. Is it right? We are talking about what are the bases in terms of accounts. Is it right? Or conventions in terms of accrual concept. Is it right? In terms of matching concept. In terms of materiality. It is right. These are all the things that matters with respect to the accounting policies as such. Is that what IS 8 requires? The IS International Accounting Standard 8 says that to select and apply appropriate policy. Depreciation. Is it right? If you are talking about appropriate IS 16, is that you have to very clear which method of depreciation you are applying, and you have to make an assumption, and for that assumption you have to give that justification. Is that you have to give that justification. That's very important whenever we are talking in terms of the policies. Is it right? That's why it says the most important is your interpretations are very important to ensure that the financial statements provide what the information is. Interpretation means so your explanation should be very clear why we are doing this. Is it right? You should be very clear in your projection. It is what happens definitely. We are very much clear about this. We are talking about economic decisions. Is that we are talking in terms of either profit or loss, or you are talking in terms of either buying or selling. That's all. Economic decision means cost, how it is going to have the cost and benefit. Is it right? Reliable, that in that the financial statement, it talks about faithful, true and fair. Is that your financial performance, and most importantly, what is the cash flow to the entity, cash flow statements, how there will be a cash inflow and how it will be the cash outflow. We will do this subsequently. Okay, we have this in our subject. Is that what is the economic substance of the transaction? Sometimes what happen? Other events. What is the economic substance? The economic substance is nothing but what? Economic substance is ultimately the bottom line is there should be profit or loss. Other events and conditions, not merely the legal form. Is that you will have so many things. You are talking in terms of warranty. Is that we are talking in terms of warranty. We are talking about in terms of social responsibility. Is that there are so many other factors which are going to influence whenever we are talking in terms of a financial statements as such. Is that what is a financial statement says? They have to be neutral and they're free from bias. There should not be any influence on that. And always make it, you have to be prudent. When you say you are prudent, you have to be cautious. You have to be very cautious whenever we are overseeing the financial statements as such. And it is complete in all material aspects. You see, there is a provision that you can make corrections. Got my point? But you should not make corrections every year. Is it right? What they say, they will say that 31st December is unaudited reports. Is it right? 31st December is unaudited report. 30th April is the audited report. Is it right? There is a gap of there is a time of 4 months. In that you can do it. Is it right? Once it is signed by the auditor, you cannot have it. You don't have any other option. Is it right? You have to be little bit careful. We have to be little bit careful. What it says, the general rules is that accounting are normally unchanged. They will not change. They will unchanged. That's the reason. What we are doing, we are making a rule that there should be a comparison, and we are making a concept that they should be consistent. Year on year basis. Is that they should be consistent and comparison. This is we are talking about these things all through the time. IS requires accounting policies to be changed. They can be changed. There is a clause only if the change requires. If there is compulsory, then only you change. Otherwise, there is no rule that we have to change. Otherwise, what will happen? We are just breaking the legal form of what the comparison and consideration. Today this year you will do one method, next year you will do another method. Definitely you cannot compare. Okay? A change in accounting policy occurs if there is a change in what? In terms of an expense is now recognized rather than an asset. Is it right? That is the reason we are talking in terms of whether we have to capitalize or not. Is it right? We are talking about the things. We will do this. Is that research is a expense and it has to be treated in the income statement. Whereas development, is it right? Development is a capitalization. You have to capitalize it because you are going to generate it. You are generating revenue from that. One development means automatically you are in the process of generating the cash. Is that is very clear. That's what we say. We are talking about what we have the very clear. Is that when when it has been taken it as a research, and when we are talking in terms of its development. Is that depreciation is now included in cost of sales rather than administration. We have done some questions, is it right? We have done some questions. What they will say very clearly, beginning, that depreciation has to be charged to what? Has to be charged to cost of sales. Fine, that's good. If they are saying that is the policy of the company, that they are charging depreciation to the cost of sales. All the way what we have done, we have shown depreciation as a expense. Okay, this has to be measurement based. Stating assets as a replacement cost rather than historical cost. Now this issue has been coming up very greatly, that whether we have to put it in a historical cost or we have to put it as a replacement cost of the asset. If there is see what happens, I will give very clearly. You have purchased on 1/1/2018. You have purchased it for how much? 20,000. Today is what? Assume today is 9th of October 2022. You want to replace the asset, is it right? You want to now if you are replacing the asset, the same asset will be how much? 28,000. Then what we have to do? We have calculated depreciation. Then when we calculate the depreciation, what you are doing? You are taking into consideration what is the thing? We will take into consideration the carrying cost. Is it? These are the various issues we are talking about. Next, not only in terms of that, intangible assets. Is it? Intangible assets. Intangible assets, the rule says that if it is internally generated, is it right? If it is internally generated, we should not consider. Is it right? It is the rule. We should not consider. Only external generated. If we are buying, then only it has to be treated as an intangible asset. Remember this, write down in your notes. Is it right? We are talking in terms of what? We are talking in terms of another factor. Is it right? In terms of, is that if it is a finite life, is it right? If it is a finite life, what you are doing? You are talking in terms of amortization. If it is an infinite life, is it right? If it is an infinite life, there is no life is there, then you are going to take it as a impairment. These are all the issues, is it right? What we have learned till now. We are going to carry forward same thing in terms of measurement basis. Stating assets at what price, is it right? In non-current assets, tangible assets, intangible assets, all these investments, is it right? We have done. When you are talking about the IAS 16, you have to do depreciation. When you are talking in terms of IAS 40, the depreciation is not applicable as such, is it right? So the difference from one standard to another standard should be very clear for us, is it right? They will judge on the multiple choice questions will be there on the same factors. Is it right? Now, is it okay about this?
Yes, sir.
Good. Is it? Now, how we have to change accounting for change? Is it right? See the thing. The change should be applied retrospectively from previously with an adjustment to what? With the adjustment to opening balance of retained earnings. Is that whatever the retained earnings are there, because what happens, the profits will be added to where? The profits or losses will be adjusted, addition or subtraction to what? To retained earnings. Is it right? That is the reason. The change should be applied retrospectively previously with an adjustment to opening balance. Mean by the time you are talking about this, you got some message. What is the message you got it? Last year financial statements we can change. Is it right? Last year financial statement. Comparative information should be restated unless it is impracticable to do so. If it is possible, change it. Otherwise, comparably, is there comparative information? Means what we have to do? We are changing for 2019 and you have to change 2018 also. You should not change only. Now when say how, you will ask me how we can change 2018 and 2019. 2018 we have to change, where we can change only closing balances, whereas 2019 you can change only opening balances. Is that opening balance? That's all. That much margin is there with us. We cannot go beyond that. Is it right? If the adjustment to opening retained earnings cannot be reasonably determined, they are giving the options. What are the options? The change, if we cannot do any changes to the retained earnings, then don't go backwards. Think about forward only. Next year, this year or next year, you think about it. Is it right? They have to do prospectively. That is, include in the current period profit and loss statement. Three things, keep it in mind. Underline this, write down your notes. I want to see how you are writing, okay? The change should be up. First, you have to change should be upright retrospectively. When you are doing this, you have to change the opening of the retained earnings. Fine. If there is a position, if it is a possibility, and change should be comparatively. That is the previous year and the current year. Fine. Next, if change is not happening, if we cannot do, sometimes we cannot do changes. Any item you take, sales, depreciation, any item is irrespective of this. It applies to every item. If the change is not happening, then don't worry about the past. Think about the current year and think about the in the future. You have to be very cautious. Is it? Just I'm increasing the. Is it? I increase. It will be easy for us. Is it? Now what happens? Is it? See, very interestingly, keep it in mind. It will come in next lectures as such. Is it right? Everything is linked. Accounting estimates are monetary items in financial statement. Definitely, we are talking about monetary item. We are talking in terms of what? In terms of currency. They are subject to measurement uncertainty. Is that we don't know when the things will, prices will increase, prices will decrease. Is that value volatile is there? But what we don't have any other option. Is that what we are doing? We are only and solely dependent on what we are. We'll talk about realizable cost, replacement cost, fair value, everything. But the ground situation is we are working only on the historical cost basis. Many figures in the financial statement require some form of estimation. Is that you want depreciation? It is an estimation. Taxation. Is that what we are doing? We are talking in terms of taxation. What we do? We say that provision for taxation. Is that we are talking about provision for taxation. We are talking about debtors. It is also estimation. Is that provision for bad and doubtful debts. Is it provision for? These are all estimations. Is it right? We are making some estimations. Is that when we are making estimations, definitely we have to be little bit cautious. When monetary items cannot be directly observed, the development of such estimates would require what? You'd need some more judgment. When you are making an estimate, definitely provision for bad and doubtful debts, you need judgment. Is it right? Provision for taxation, you need judgment. How much we have paid last year, before year, how much the sales will be there, whether the sales are increasing, that definitely. Accordingly, provision for taxation should also increase. Is it right? This is what it says. Assumptions of the latest information available. These accounting accounting estimates include what? You are talking about the depreciation, you are talking about the fair value of an asset or a liability in terms of taxation, in terms of provision for doubtful debts, and net realizable value of inventory. This is very, see, this is one of the issues. If you are thorough, if you are have a good control over this inventory, you can argue anywhere. Is it a inventory net realizable value? How much is the inventory? What happened? Assume that you have bought inventory for 10,000. Down the inventory is obsolete. Is it right? It's not. Now you want to sell this inventory. Is it right? Now you want, when you are making you need judgment. Is it right? That is the reason you have to be very careful. You need judgment how much you are going to sell it off. Definitely, what happens, whatever the value you are going to sell at that point of time, that is going to be treated as net realizable value. Fine. Now, that is what it talks about. There are three big ways. One is depreciation, one is in terms of fair value of assets or liabilities, and most importantly, we are talking about NRV. Changes in the requirement of IAS 8 says that effect of change in estimate should be included in as simple as that, should be included in the profit and loss account, and subsequent periods are, if subsequent periods are affected, in those subsequent periods also. Is it? If there is any changes, plus or minus, you have to treat. That's as simple as that. We don't need more elaboration. The effect of changes should be included in the same income and expense classification. Understand what? Rent means rent only. Rent received means rent received only. Rent paid means rent paid only. Okay? Administration is salaries means salaries only. Warranty means warranty only. We should not. Now we can understand. Last time we have done, if there is any revaluation gain and revaluation loss, is it right? Revaluation gain or revaluation loss should not be disturbed, is it right? If there is a revaluation gain from land, revaluation loss from the land should be deducted from the revaluation gain of the land only. That the same concept, is it right? Wherever it's possible, I am going to back and I will explain, I will revise the points also in summary. Is that if the effect of the change is material, the amount has to be disclosed. Now, what is the material? Material means how much is there. There is auditing, there is a condition is there. 1% of sales. Is it right? 5% of profits. If the amount is really noticeable, is it? If amount is really noticeable, then that amount has to be disclosed, that you are changing this much amount for your in the financial statements. What are the examples of changes? You have useful life of the non-current assets. I told you, first we will say it is for 10 years. Is it right? After 4 years. Is it right? After 4 years, you will revise it. Is it right? You will revise it and say that the revised life is only 2 years. Fine. You will say after revised life. You don't have any other option. As simple as that. Is that? You have to disclose it. That's very important. You do anything, you disclose it. The 50% of the accountability will be gone. Okay. The method of depreciation non-current asset. You should not often change the method. Getting my point? You should not often, if you think that return down value to straight line method or straight line method to return down value. You have to give justification why we are doing, why you are changing. Usually, normally, there will not be any change in the value of the method of depreciation. Life will be there. The life of the asset can be changed. There is a possibility. But method of depreciation, you have to be very, very careful. Sometimes what will happen, you will have warranty provisions. Is it right? Now warranty, they will say 6 years warranty. Is it right? If you are taking a car, it is a 6 year warranty. Now warranty, what will happen? Definitely there will be some changes will be there in the warranty. Is it? You're talking about extended warranty. Is it right? If you pay a little bit more, you will get some extended warranty. That conditions, because here it is not in the hands of the company, it is there in the hands of the customers. Is that you will offer the price and it is the customer who is going to consider or who is going to take the judgment. Okay, this is the basic things where there will be change in estimates. Is it prior period errors, past year errors? Is it right? How it will be happen? There will be some prior period errors or omissions. Is it? I had told you three types of errors: error of principal, error of commission, error of omission. Is it right? I have told you, yes or no? Yes. Okay. Types of errors. Again, I am writing. Is it right? What are they? The principle of commission. Is it right? Principle of commission, principle of omission, and principle error of commission, error of commission, error of omission, and error of principle. Is it? So happen. There's no factor that will not misstatement. Sometimes what will happen? You are not showing the right values. Someday there will be totaling mistakes. Something will happen. That is the reason. What you will do in extreme cases, what we will do, we are talking in terms of what? Suspense account. Is it? We are talking in terms of what? We are talking in terms of suspense account as such. Is it? That's the way. Is it? The financial statements for one or more periods arising from a failure to use information that was available when the financial statements for those periods were authorized for issue. Is that means you have the information, but it's not one person. Is it right? It's a huge factor. If there is error of omission, you cannot deduct it also. It is reasonably expected to have taken into account in preparation for those financial statements. We assume that the information has taken in totality. That is the reason when you make a point, what we'll say, you say true and fair. Is it? We just we should not, when you say true and fair, you say that there is a possibility of some errors. Is it? Such errors are mathematical mistakes of policies, oversights, and some cases there will be fraud also. Current period errors are discovered in that period, should be corrected before the financial statements are authorized for issue. Got over? You should, current year errors is not a big issue as such. Is it? Correction of the previous year errors, how you have to deal it? We say that you have to restate the opening balances. You can state replace, that's the elements of financial statements, is that the opening balances, liabilities, you have the equity, is it right? And you can do only for opening balances, and most importantly you can do it for what? Retained earnings also, because see, the retained earnings is nothing but accumulated profits. Okay, last year profits plus this year profits. Restating the comparative figures presented if the error has never occurred. Is it right? Means you have to make a comparative figures also. Means 2 years depreciation is changing. Is it right? Depreciation, you have to do it for the current year, you have to do it for the previous year. Disclosing these accounts in the financial statements at the beginning of the earliest we should not delay it. Is it right? In effect, this means that 3 statements of financial statements will be presented with a set of the thing. If we are doing this, what we are doing, how many financial statements getting affected? At the end of the current year, at the end of the previous year, and at the beginning of the previous year. Means if you are making corrections, definitely where there will be a impact with respect to the values. Is it right? In 3 places it will be get impacted: current year, previous year, and the opening balances. Is it right? So we have to be first we should not try to minimize it, Once you are minimizing it, if there is any possibility, then you have to make those corrections. Is it right? This is with respect to prior year error. Is it right? Now, got my point? What we have done, we are talking in terms of what? We are talking in terms of the accounting changes in the policies, what happens with the estimates, and subsequently what happened with prior period errors. Okay? Now, they gave you a small example. Is it right? They gave you a small example how to do. During the year, is it clear about this till now? Is it okay? Where are you people? Good. Is it? Now, what it says, it is a textbook question, okay? It is a textbook question, and keep it in mind. The same questions have been repeated in the examination also. Similar with some additions, okay? With some addition, with some changes. During the year 2001, discovered that certain items had been included in inventory of last year at a value of how much? 2.5. But they have not been sold before the year end. You have included some inventory during the 2001. Is that during the current year? Is that during the current year? They have this year you have discovered that there some inventory items has been included in the last year 31st December 2000 worth of 2.5 million, which was not sold at all. Got my point? The original figures reported for the year end 31st December and the figures of 2001 are given below. Sales, they have given sales in thousands. Is it right? In thousands. This is very, very clear. Is it? In thousands. Sales, cost of sales, is right. If it is in thousands, it is also how much? It is 2,500. Okay? It is 2,000. That's very, very, very simple. You have to be clear that how it is going to be worked for us. Is it right? Now, that's all. Sales is there, cost of sales is there, gross profit, tax and net profit. Fine. The retained earnings, opening balance. Is that this is the last year, previous year opening balance. Is it right? Previous year opening balance is 11.2. The cost of goods sold includes 2.5 million. Error in opening inventory. Is it right? In 2000. Show the 2001 statement of profit and loss account with comparative figures. Means we have to show it for the last year and we have to show it for the current year. And the retained earnings for each year. Is it? Disclosure of OCI is not required. Assume that the adjustment have no effect on the tax charge. Means tax will remain same. Okay? If that is the case, what you have to do? See, if they are saying this, fine. Now, what they have mentioned that a company discovered that certain items have been included in the inventory on 2.5 last year. Is it right? 2.5 included at December 2000 at a value of, but they have not been sold before the year end. Means already they have deducted. Is it right? Already they have deducted, but they have not been sold. Is it right? Already they have been deducted, but they have not been sold. We have to make sure. In that case, what you have to do in the fine. Okay, what we have to do? They have given you inventory. Is it right? Inventory. Where the inventory will buy? The opening inventory plus purchases minus closing inventory. Is that cost of sales is what? Okay. Now 2001 and 2002. Here what we have to do? We have to only focus on this. Is that we have to focus only on this and how it will have impact on the profits. When you say it has been included, means you have to think about that. It has been not been sold. Is it? If it is not been sold, you have to add inventory here. And you have to deduct inventory here. Is it right? You have to add in because it has been included means it has been included in cost of sales only. Is it? It has been included in cost of the closing stock will have impact on the previous year opening balances. We have to correct it and subsequently we have to correct the current year balances also. What are the three statements it is going to be affected? At the end of the current year, at the end of the previous year, and at the beginning of the previous year as such. Okay. Now, slowly we will work it out. That's all only. You make it a inventory, automatically things will be very clear. Step 1. Okay. When we are talking about the step 1, write down. Okay. You also write down with me. It makes really difference in your understanding. Okay. Write down statement of profit or loss 2001 2000. Fine. Sales. How much is the sales? Sales is 52,100. Okay. Sales is how much? 48,300. Cost of sales. Is it right? See, they have included in last December 2000. Is it right? Means you have to and not been sold. Is it right? Not been sold. Very simple. Means if we have included in 2001 means already we have deducted from the cost of sale. Opening stock plus purchases minus closing stock. Understand what? Minus closing stock means it has been deducted from the closing stock and it has been not been sold. If it is not been sold, you have to add it back. To which year we have to add it back? We should not add it back for the current year. We have to add it back for the last year. When you are adding back to the last year, definitely in the next year, that is in the current year, you have to deduct it. Is it? Cost of sales. How much is the cost of sales? 2001. Is it right? Cost of sales 2001. How much is there? 33,500. Is it? 33,500 minus. From the current year you have to deduct. From the previous year you have to add. Is that? We are doing this only because we are talking in terms of what? We are talking in terms of closing inventory. Is that? How much is there? 33,500 minus 2,500. It comes to how much? 31,000. Is it right? Is it okay? 2,000. Is it? 2,000. Yes, Shifa. Is it fine?
Yes.
30. How much is there? For cost of sales 30,200 plus 2,500, 2.5 million. Okay. How much is the 32,700? Very important to understand this. Is it right? How we got 2005? Means it has been last year. It has been included. Is it right? Means opening stock plus. That's a very simple. Opening stock plus purchases minus closing stock. We have deducted from the closing stock which has not been sold. Again, you have to add it back to the last year, and because it has been carried forward to the next year, definitely from this year you have to deduct it. How much you will get? How much you will get? 001 where are you, Rizwan? I'm waiting. Yeah, 21,100. And here how much you will get? Here how much you will get? For the next 2000, 13, 6, it comes to how much? 15,600. This is the gross profit. This is the gross. That's all. Nothing is there. They say that tax will remain same. Is it right? Tax will remain same. How much? 4,600. And here how much? 4,300. It comes to how much? 11 minus 6. 11 minus 6, 5. 10 minus 4, 6, 1. 3, 1, 11,000. This is the net profit. Restated. Fine. Restated net profit. Fine. Step 2. Is it right? What they are saying is show the statement of profit compared to and the retained earnings. Only for retained earnings they are talking about. Is it right? Retained earnings. Is it? They gave their retained earnings. Okay. Now, reopening balance. How much is the retained earnings for 2001? How much is the retained earnings for 2000? Retained earnings for 2000 is 11,200. Fine. What is the retained earnings of 2001? What is the retained earnings of 2001? Any idea? Yes or no? See, 2001. Fine. Okay. See, what is the retained earnings? See the things. Retained earnings. Is it right? Retained earnings. What is the concept of retained earnings? You will have the retained earnings plus you will add what? You will add profits. Is that current year profit? Profits of current year. Okay? Current year. Fine. Now, what is the retained earnings of 2001? You have the last year retained earnings. Last year retained earnings are how much? Last year retained earnings are how much? 13,800. Is it right? Current year profits are how much? How much is the current year profits? We have calculated current year profits. How much is the current year profits? The retained earnings of how much? Is it? See, 1 minute, 1 minute, 1 minute, 1 minute. One minute. Retained earnings of 2000 is how much? 2000 is how much retained earnings? Retained earnings of 2000 is 11.2. Is it right? 11,200. Is it right? Current year profits. This is the profits for which year? This is this is 2001. This is the profits. 1 minute. Is it right? Is it right? Fine. This is the add profits. Is it right? Profits of what? Profits of 2000. Profits of 2000 is how much? 13,800. Okay. Profits of 2000 is how much? 13,800. It comes to how much? It comes to 25,000. Again I will explain you this. Okay. Put one star mark here. Is it right? Put one star 1. Okay. It will be here. See how much is the earnings on 2000? Opening earnings of 2000, 11,200. They have given 1st January 2000. Okay. During the year 2000, there is a profit of how much? 13,800. 11,200 plus 13,800. How much the retained earnings will be there? Retained earnings will be 25,000. Fine. Now, for this 25,000, we have overstated the profits. Is it right? We see if we have done this, if you remember, is it right? Inventory is overvalued or inventory is undervalued. Is it right? If closing inventory, very quickly I will do this. Is it right? Just for your understanding. Is that opening inventory plus purchases minus closing inventory? Okay. I will just take it. Is it right? I will put it two columns. Opening inventory is, I will take how much? 2,500 only. Okay. To opening inventory is 2,000. Closing purchases is 10,000. And closing inventory is how much? You have included closing inventory is how much? 2,500. Okay. What is the cost of sales? 12,000. It comes to 12,000 minus 9,500. Okay. See the things. Now, 2,000s, 10,000s. Is it right? You have to deduct the inventory. No inventory. Is it right? What will happen? The cost of sales is 12,000. Fine. Now, sales, is it right? Sales minus cost of sales. Sales assume 29,000. Is it right? I am giving both the options. I am showing how the profits will get affected. Okay. Sales is 29,000. Cost of sales is how much? 9,500. Is it right? It comes to how much? 19,500. This is what your gross profit. In this case, cost of sales is how much? 12,000. Is it right? Cost of sales is how much? 12,000. What is the gross profit? Gross profit will be 17,000. Is it right? Gross profit will be 17,000. Means if we have included the sales, the profits will decrease. If you have taken the actual amount, the profits will, means if the closing inventory is overvalued, gross profit will decrease. Remember this very crucial point. It will be tested in at least in 2 or 3 topics. This is there. We have done in the previous case also. We are in one of the lectures we have done this. Is it right? And now also we are doing this. Inventory. Inventory is how much it has been deducted. Gross, when you have deducted the inventory, the gross profit will reduce. Now what you have to do, you have to make sure that the things has to be restated. Is it right? What we have done here, in this case, see the thing. I am putting this. In 2001, what we have done, we have deducted inventory. How much we have deducted inventory? 2,500. Fine. Again, the same treatment has to be done. In 2001, what we have to do? Prior year error in terms of inventory. How much is the prior year error? 2,500. Again, we cannot go beyond this because already we have taken the 11,200 here. Is it right? How much you will get? Here you will get 22,500. Here you are getting 11,200. What is the retained earnings restated? Again we will do this inventory. At least by the time we complete this for the next almost 2 months, we at least will do 5 or 10 times the same adjustment. The same adjustment. Immediately you have to do what, that is the reason I have shown it on the left hand side, that how the gross profit will get affected. Okay, how the gross profit will get affected. Now, fine. Now, what is the net profit? Restated net profit. Is it? Restated net profit. How much is this the restated net profit? Add. It comes to how much? 16,500. And here it comes to how much? Same thing, 11,300. 0,00193. 0,0522. Is it? Retained earnings as on 31st December 2001. Are you clear about this? One minute. One second. I will revise it. Is it right? What they have said that, see, very simple. What they have said that 2,500 has been included but not been sold. When 2,500 is included and not been sold, definitely we are overstating the cost of sales. Is it right? We have to add back 2,500, which is not sold. Definitely we should not consider it in the cost of sales, especially where closing inventory only. Is it? Especially in closing inventory only. Last year closing inventory, because it has been not sold, we have added. Definitely, we have added. Now in the opening inventory already we have added. Is it right? Now we have to deduct it. Last year, again, when you are making a readjustment, last year inventory we will add, and this year inventory we will deduct. That's all. Is it right? Other things will remain same. No changes. Again, when you are talking about the retained earnings, because what happens? Because of this inventory, gross profit got affected and net profit got affected. Is it right? Gross profit got affected and net. Because of that changes, we are just making the changes for the inventory. Is it clear?
Yes, sir.
Fine. Just revise it. If you again, when you are doing the exercises, we will do again this one. I know. By this I can understand that you will find how inventory is impacting the thing. That is the reason on the left hand side. Is right? I gave you this example. Is it right? I gave you this example only to make sure that how it is going to have impact on the inventory as such. Is it right? This example, I will give this example all through the time. That is the only way we can understand. Now, this is the first segment. Is it right? Changes in accounting policies, or how we have to make a change prior year errors. Is it right? The second option, the second point is we are talking about something very new, first time, IFRS 13. We have done little bit IFRS 3, business combination, little bit, very little. Is it right? We have done touch and go. IFRS 13 is talking about the fair value. How you have to determine the fair value. Nowadays, people are concerned about this very much. Is it right? The objective of, see what happens whenever there will be a sale or whenever there is a purchase. You should know what is the actual value. We cannot go by the book values, or we cannot go by the historical cost. The objective is to provide a single course of guidance. Is that with respect to fair value measurement? What is the fair value? Is the price that will be received to sell an asset or paid to transfer an liability. Okay, whether you are going to buy or you are going to sell. Okay, that is the at what is the value, how it is going to have a impact. Is it? Now, when you are talking about the fair values, there is that's the only thing we will take into consideration. Is that I'm not going to do anything beyond that. The fair value is nothing but what is the value which you are going to receive to sell, or we are going to pay off the liability as such. Is that where we are doing IFRS 13? Here we are just identifying this. Subsequently, we are going to do in something in detail. Why we are doing this? We are talking about what are the other standards. One of the standard is the IS 8, changes in the policy. The second reporting standard is IFRS 13. Okay. Now, what is how we are going to work it out? This again another standard is that we will go in detail. Don't worry about that. We have IS 2, is that inventory. IS 2 inventory have two methods. The first one is the cost. The second one is the net realizable value. Fine. If we are talking about the cost, we have, I think somewhere in F5, you have done this. Is it right? First in, first out, average cost, actual cost. Is it right? LIFO, FIFO, all those things. Is that? That is the cost determination. Is that net realizable value? What is the expected selling price minus any selling cost is there. Is it right? Any selling cost, we have to deduct that selling cost before arriving at a net realizable value. Is it? Inventories are valued at the lower cost or net realizable value. These are only two methods are there. Is it? Don't make it that we are having, people will get it involved that you have LIFO, FIFO. LIFO, FIFO is subdivision of this. LIFO, FIFO is the second level classification of the cost. It is not the first level classification. That cost is bringing home whatever the cost we are going to incur. Is it that we have to add all the relevant cost? It is right. We will say that it is going to be pre-operational cost. Is that pre-operational cost, and we have to calculate post-operational cost. Pre-operational cost will be capitalized. Is that purchase cost, import duties, all those things? Is it? Just for you can go through it. It's very simple way of understanding. Cost of conversion. Is it? You are converting the things in terms of what? Units of protection. You have direct labor, direct expenses, and overheads. Is it right? Protection overheads, other overheads, all those things. Is that there is also this is the first classification when it is related to the purchases. This is the second classification with respect to the manufacturing, and only two things. The following cost can be excluded and charged to expenses. Any waste, any storage cost, any training cost, any selling cost. Is it right? We should not take that into consideration. Is it right? Now, see, this is the basic concept. We have done little bit. We are not going into detail. Subsequently, we go in detail. IAS 8 changes in the accounting policies, and we are talking in terms of IAS 2 with respect to the methods, IFRS 13 in terms of fair values. Is it right? Other standard, the last one. Is it right? It's only introduction. Keep it in mind. Don't say that way. The one of the standard is we are talking in terms of, we have done IS 40 investment property. Is it right? And IS 41 is related to agriculture. Got what? It's related to agriculture. When we have the related to agriculture, they have classified two things. One is you are talking about biological assets in terms of all the crops as such. Is it right? We are talking about the agriculture produce in terms of whatever the production we are talking. One side we are talking about the crops, one side we are talking about the output. Is it right? You have to make a clear distinction between what is the biological assets and what is the agriculture produce. Now, how we have to, biological assets is nothing but teak, timber, trees. Is it right? You are having trees, you have, is it? Now, agriculture produce means very simple, rice. Is it right? When you take into consideration rice is agriculture produce, it will not come in under the biological assets as such. Recognized at the fair value, definitely the price of these assets will change as per the demand and supply. Is it? Recognized at the fair value, less any cost to sell. You are producing agriculture products, is it right? Then what will happen? You are converting that agriculture products into sales. Definitely there will be a selling price. Is it right? Again, we somewhere we should take into consideration the net realizable value concept. Is it right? That is the fair value. Fair value means what? What is the value which you are going to receive at the time of sale, or we are transfer of the liability as such. Is it? What are the three things? One is your biological assets, one is your agriculture produce. There automatically what will happen? There will be some grants will be there. Is it? You will have grants or you will have subsidy. Is it? You will have the grants. Is it right? Grants from the government. Is it right? Grants from the government. In most of the cases, wherever the agriculture products are involved, there is no taxes. Understand? Whenever there is agriculture products are involved, most of the countries, they will not impose any taxes on those agriculture products. Is it right? When conditions are satisfied, you are taking that into consideration. What they say here, they gave you a small example of this. Is it right? What is the biological assets? Biological assets are living animals or plants. Is it right? A biological asset should be recognized if it is have a probable economic benefits. Is that people will do camels? Is that right? They do business for camels. They do business for goats, herds. Is it right? Buffaloes, cows. Is it right? They do every wherever there is a sheep. Is it right? You are talking about the goats. They will buy and sell. Those are called as biological assets as such. Is that? Now, what is the agriculture products gains or losses including in the profit and loss account? They are mentioned here. After produce has been harvested, is that IS 14 ceases to apply. Agriculture produce becomes an item of inventory, fair value less cost. To sell at the point of harvest is taken as the cost of purpose. For what? IS 2. Is that when we are talking rice, as simple as that, you will harvest it, you will process it, then you will sell it at the end of the day. Is it right? These are the basic classification. Just remember this. Somewhere we will, if it is needed, we are going to work it out. Government grants. What they say, Government IAS 41 applies to government grants. Is it right? Related to biological assets. Unconditional government grant received in terms of that's as simple as that. You are talking in terms of any agriculture plants. Is it right? Dates, as simple as that. Is it right? Government will give grants if we are involved in that type of activity as such. If such a grant is conditional, then the grants require an entity not to engage in certain agriculture. I mean, there will be a conditional grant. Is that how you are going to be work it out and where we are going to sell it off? Is it right? Means if it is in this case, you have to be very specific. What is IS 41? See, now the moment you will go forward, you have to repeat all these things. Is it right? And something you should keep in mind. How? Not in detail, very simple, but you should know its scope of standard. I'm making it very clear. Every standard, there should be some scope. What we are talking in terms of IAS 23 borrowing cost, what we are talking about IAS 20 government grants. Is that what is the capital grant and what is the revenue grant? Is it right? When we have to deferred grant, when you have to treat it current liability, when you have to, how we have to treat it non-current liability. Got my point? These are the things. When you have to, what is the concept of IAS 16 and what is the treatment with respect to IAS 40 when we are converting a property and plant to investment property. Is it right? Property, plant and equipment is converted to investment property, how the things will change. Revise this, very, very specific. They will ask you the basic concepts. Fine? Is it okay? One minute, I'm getting a bottle of water. 1 minute. Fine? Now, in the textbook they have written something different. Okay, I have changed the name. I substituted it camel. Okay, it is okay. This is an example with respect to biological asset. Is that what they have said? A herd of 5. Is it right? A herd of how many? 5 4-year-old camels was held on 1st January. Is it right? What is there on 1st January? Put it as a solution. Very basic concepts. Okay, keep this concept when we are doing the section A and section B. Follow these rules. Is that you will be more clear on that. Now solution. Is it right? What they say, I'm just putting it very roughly. Okay, what they say, this is on 1st of January 2003. Is it right? 1st of January 2003. How many camels are there? 5. Is it right? 5 was held. Is it right? There are 5 camels. Fine. Next, on 1st of July. Is it right? 1st of July 2003, a 4.5-year-old camel was purchased. Is it right? They have purchased another camel. Fine. The fair value less estimated point of sale cost was 4 year is how much? It is 200. Is it right? The value is how much? 1000. And they have purchased on 1st July. How much is the 1st July is 212. Is it right? How much is there? 1212. Is it right? Now, fine. They have sold 5-year-old camel 4.5. See this plus 1 full year, it comes to 5. This plus 6 months, is it right? It comes to 5 years. Is it right? Then what happened? The 5-year-old camels. What is the value? The value of 5-year-old camels is going to be, the camels value is how much? It is going to be, is it? Value of camels, is it right? Put it as a fair values. Okay, fair values. How much is there? It is 230 times 5. Is it no? 230 times 6. How much will get? 6 3 is 18, 1, 6 2 is 12, 13. Is it right? Please check. This is going to be what? This is going to be called as a carrying amount. Is it right? This is going to be called as a carrying amount. Fine. Is it right? This is the sale value. Is it right? The fair value less estimated point of sale cost. Is it right? This is the sale value minus, is it right? Carrying value minus carrying value. How much is there? 1212. Is it right? 8 6 1. Is it? This is gain on sale of camels. Okay, what they say, calculate the amount that will be taken into statement of profit and loss for the year. Is it right? For the year. Right? If they are talking about how much you have to take, this is the gain. Gain on sale of camels. Is it clear? Is it okay? Fine. 1380. Yeah. Okay. Yes. Fine. Next. McDonald's operate a dairy. Can I start now? McDonald's operate a dairy farm January 1st, 2001. How many? Again, is it right? This is a biological asset. They will ask, is it right? They will ask one question on this. Is that nowadays it is very hot topic. Okay, nowadays it is very hot topic. Is that McDonald's operate a dairy farm in January 1st, 2009. January 1st, 2001. How many cows are there? 100 cows. Is it right? 100 cows. And 100 cows of how much? 100,000. Fine. 100 cows of how much? 100,000. He owns 105 cows. Is it as on 31st December? As on 31st December. As on 31st December, how many cows they own? 105 cows into how much? 1,100. Is it right? 1100. During the year, just keep this 1 minute. I'm not doing anything else. Okay. During the year 2001, is it right? How much milk he has been sold? 40,000 gallons. 40,000 gallons at the rate of 5. Is it right? How much? 40,000 gallons at the rate of 5. It comes to 200,000. Okay, $200,000. When cows are sold at a local market, the auctioneer charge commission of how much? 4%. Is it right? The auctioneer charge how much? It is 4%. Fine. At January 1st, 2001, he owns 100 cows, 1,000 each on a local market, and 31st January he owns 105 cows of 1,100. During the year, he sold gallons of 5. When the cows are sold in the local market, they will charge it. Show the extract of financial statement for these activities, assuming that no cows were purchased or sold during the year. Is it right? No cows are purchased or sold during the year. Fine. Is that how much they are generating? They are generating the income. Is it right? They are generating the income is how much? They are generating the income of 200,000. Is it right? Now what happens? The value of the biological assets are increasing. Okay? The value of the biological assets are there. We should know the what is the value of the. We have to only know the value. We are not going to about any purchase or any sale. Understand point? We are not concerned about any purchase or sale. We are only concerned about the valuation. Is it right? We are only concerned about the valuation. Value of cows. Is it right? Value of cows. Is it right? Put it in fair value. Is it? Put it fair value. The first one is what? 1. Is it right? How many cows are there? 100 cows. Is it right? 100 cows. What is the value of each cow? The value of each cow is 1,000. Is it right? 1,000. Fine. How much they will get? It comes to how much? 100 into 1,000. Is it right? 1 minute. 1,0,0,0,0. Fine. Less 4% commission. Is it right? Less 4% commission. How much is the commission? 4% commission. It comes to how much? 4,000. Is it right? It comes to how much? It comes to 4,000. How much you will get? 96,000. Fine. This is the first case. Next, 105 cows. 105 cows is how much? 1,100. Is it right? I'm writing in a separate one. How much you will get? 105 into 1,100. 105 into 1,100. It comes to how much? It comes to 115500. 11. Good. Less 4% commission. Is it right? Less 4% commission. How much you will have 4% commission? Is it right? 4620. Where are you, Rizwan? Is it right? How much you will get? Difference is how much? Difference is how much? 110,880. Increase in value of 5 cows, because 105 minus 100. Is it right? What is the difference? Difference is how much? Increase in value of 5 cows. How much is the difference? You have to put that. Fine. How much is there? 110,880 minus 96,000. How much is the difference? Difference. It is increase in value. Is it right? 4,880. Is it right? 4,880. Is it right? 4,880. Right? This is what is it? 4,880. Now, right? Profit and loss account. Is it right? Profit and loss account. In profit and loss account, what we'll do? This is step 1. Okay. This is step 1. 1 minute. This is step 1. This is step 2. In profit and loss account, first you will show the revenue. Is it right? Revenue from sale of milk. Correct? Revenue from sale of milk. Revenue from sale of milk. Is it right? Revenue from sale of milk is how much? It is how much? 400,000 times 400,000 times 5. Is it right? 400 times 5. It comes how much? 200,000. Is it right? This is only an extract. Okay, you know, extract is only just we are showing what is needed. Is it right? Increase in value of cows. Gain. Is it right? Increase in terms of gain. How much is that? Increase in value of cows. Is it right? How much is that? 14,880. Okay. This is related to the profit and loss account. With respect to the financial statements, statement of financial position, when you take the financial position, you will see it as a biological asset. Is it right? You will show it as a biological asset. Is it right? In biological assets, you will show the value as on 31st December. Value as on 31st December 2001. How many cows? 105 cows. Is it right? How many cows? 105 cows. What is the value? 110,880. first time you are doing. Is it right? First time you are doing. Till now we have done with respect to, is it right? You will find you should have this doubt in your mind. Is it right? This is very important. You have what happened? There is an increase in number of cows, 5. Is it right? Because of increase in cows, there is an increase in value of the cows. Is it right? If you take into consideration, see the thing, 14,880. 14,880 divided by 5. Just do it. 14,880 divided by 5. Value of the cow is how much we have estimated? 1,000. Is it right? Value of the cow, how much we have estimated? 1,000. But when you take the difference, is it right? And because that is the difference includes the commission related to 1,000 cows and the commission related to 1,100 cows. Got my point? This is the first time. Don't get panic. I know you will find this is the separate way of doing the calculation with respect to IAS 41 biological assets. Is that when there is an increase in cows, you will say that, you will say 5 cows has been increased, fine, that is the gain which you are going to, but are we getting the proportionate gain? No, we are not getting the proportionate gain. Is it right? One at the beginning of the year, listen carefully, at the beginning of the year, 100 cows, each cow is how much? 1,000. At the end of the year, each cow is how much? 1,100. Okay? 1,100. But how many cows has been increased? Only 5 cows. Is it right? 5 cows has been increased because now you see the things. Is it right? You see the thing. 1,000 is the beginning value. Closing value is how much? 1,100. Fine. There is a gain. Is it right? There is a gain. Gain with respect to what? Gain is respect to 1,000 cows plus gain is respect to what? 5 cows. Understand the point? Gain is respect to 100 cows plus gain is with respect to 5 cows. There is a gain, is it right? There is a gain with respect to the holding of the cows. Is that we are taking the gain values only. That is the reason. Is that think very carefully, very sharply. Is it right? You will get immediately you will get confused. Why we are talking about 5 cows when we have increased it 5 cows? Why we have to show it in the income statement? No, in the income statement, 100 cows in the beginning. You have 100 cows in the beginning. You have at the end of the year you have added 5 cows. Is it right? Beginning of the year $1,000. End of the year $1,100. Only the increase in quantity is 5, but the increase in amount is a different. Is it right? We have to take the different gain increase in the value of 5 cows. That is the difference. Is it okay? Yes, Rizwan and Shifa. Little bit. I am very convinced. Sir, you need some more explanation on this. The moment we will do some more examples, the clarity will increase. Don't worry about that. First question, we will have some doubts will be there. It's a part of the system. Okay, don't worry about that. The more we give me time, the more we'll do, the more the clarity will come. Which two of the following situations would not be required a prior year adjustment as per IAS 8? Is it right? Which of the two situations would not require What is the rule of IS 8? First, make it a point. I'm going back to IS 8. Okay, what is the rule of IS 8? First, we will go through prior year. Prior year errors are omissions, misstatements, the financial statement, one or more prior periods arising from the failure to use information. Is it right? Prior years, such errors include mathematical mistakes, mistakes in applying accounting policies, oversight, and fraud. Okay, means these are the conditions of the prior period errors. Now you read the question, you will understand in a much clear way. Is it right? It's what they say. In last year financial statements, inventory is understated. Is it right? Inventory by a material amount due to system error. Is it? Due to system error. Which of the would not require? They say they would not require prior year adjustment. If it is understated by material amount, it requires. Is that? It requires. As simple as that. Means this answer is no. They say which would not require. Is it right? Which would not require. Fine. Next one. A company has changed its allowance from irrecoverable receivables of 10% of outstanding debt to everything over 120 days old. Is it right? A company has changed. Is it material? Yes or no? Here it is material. Is it right? It is material. When it is material, it is required. Is it material? A company changed its allowances. They have what they have done? They have changed the policy. They have not changed the amount. Is it right? If they have changed the amount, it needs adjustments. If they have not changed the amount, that doesn't mean any adjustments. Is it right? Allowances. Company has changed its allowances for irrecoverable from 10% outstanding to everything 120. Now, what happens? Another one. See here what they mention it very clearly. They mention it what? They mention last year financial statements. They mention it very clearly. Last year financial statement. When they say last year financial statement, you have to do it for the last year as well as for this year. Fine? It requires. Whereas they have not mentioned anything last year in the second point. Is it right? If they have not mentioned anything, it is not required. Reason. When you are going to the option, see the reason, logic. What is the cause and what is the effect? What is the reason and what is the result? A new accounting standard has been issued that requires company to change its accounting policies but gives no guidance to specific application to change itself. Is it? A new standard has been issued that requires to change accounting policy. They are saying they have to change according. They say that a new accounting standard has been issued that requires a company to change its accounting policy, but gives no guidance. Is it? But gives no guidance. Is it? Now, when you're talking about the accounting policy, is it right? When you are talking about the accounting policy, what happens? It will be material or it will not be material. First you have to say, if it is going, see when you are changing the accounting policy will have impact on previous year, is it right? Previous year and current year. Is it? Accounting policy requires previous year and the current year. Is it? That requires a changes but gives no guidance on specific application. They're not talking about the specific applications. Is that how it had to be changed? But the moment you say it is going to have impact, it is going to be material in nature. You have to know the reason, and you should know if it is material, it is required. Is it? Now, is it, what happens? See the thing that see when you are talking about IS 8, is it right? When you are talking about the IS 8, what are the three different situations we have done? We have made it very clear. There are three clauses are there. Is it right? There are three clauses are there. Just I will revise that clauses. Is that what is the clauses that have been given? They have given 1 minute. Where it is there? Yes. Here it is. Slide number 6. Is that right? The change should be applied retrospectively to the opening balance of the retained earnings. There should be the required treatment. Is that what their question is? Would not require. The change should happen retrospectively. First thing, the comparative statement should be restated, the second condition, and if it is difficult, then you have to treat it from the future. Okay, you have to treat it from, again, the change should be happen retrospectively, means from the previous year, and you have to change the opening balance, adjustment for the opening balance of retained earnings. Second thing, there should be a comparative information has to be restated, last year and this year. Then only you have to change. And the third one is, if it is not going to have from the previous year, you have to change it in the, if it is impossible, then you should change for the current year, and you have to change it for the future year. These three conditions, if it is going to be satisfied, then you have to do the changes. If it is not satisfied, any one of that is not satisfied, you should just ignore it. Is it right? I'm putting here, refer slide 6. Is it? Refer slide. A company has chosen to value inventory using FIFO, is it, rather than as the previous periods. What will happen? A chosen to value inventory. If you are chosen to value inventory, what will happen? There will be a prospective impact. Future we are going to change. It is going to be required. Is it? If chosen to value using the method of inventory is changing, it will have impact on the profits. If it is having impact on the profits, the financial the estimates has to be revised. A company decided to move from charging depreciation on a straight line basis to the reducing balance basis. Is it? See the thing. They have changed the depreciation from the straight line basis to reducing balance basis. They are changing the method. Is it? They are changing the method. Is it? Now they are not changing previously. They are changing what? In future only. Is it? They are not changing previously. Understand my point? Whatever happened previously they use charging from the straight line method to return down value method. They are talking about the future. They are not going to make any adjustments in the past. Is it? When they don't have going to make only in the future they are going to change, then it is not material. In future only they will change, is it? If it is not material, it is not required. Again, only those three conditions, just you make it a point. Is it at IAS 8? That is the scope of the standard. The first one is if there is any changes, it has to be change in the retained earnings. Second, it has to have a comparatively impact with respect to the changes. Third one, if it is not going to have any, there is no possibility of the past, then in current year or in the future year we have to change it. Is it right? If that is the case, what will happen? Last year financial statement inventory is understated by material due to systems error. It requires, because it is affecting the profits. Is that? Receivables have changed its allowances for recoverables. They are changing. Getting up and keep it in mind. The moment they change, is that they are going to, the moment they are changing, definitely it is not. Here also what happening? They are changing the method. Is it right? They are changing the method as such. Here also what they are doing? They are choosing the value from one method to another method. Is it okay? Is it? Here also it's not material, and it is also here it is not material. Are you clear about this? Simple. See, okay, no. Keep it in mind. The moment we will do practice, we will get more clarity on this. Is it right? More clarity. Just keep the scope that where there is changes are required. That's all. If it is not in that clause, definitely changes are not required. In accordance with accounting policies, changes in accounting estimates and errors, how a change in accounting estimate is accounted for. If in accordance with IAS 8 accounting errors, how the change in accounting estimates accounted for. Again, just for your understanding, I will go for that slide. Okay, it gives you some more specific classification. Is it right? When you are talking about IAS 8, is it right? Is that IAS 8? What it says? You are talking about the account. What the question it says? The question says that. Oh, 1 minute. The question says that as per accounting estimates and errors, how we are going to make changes. How we are going to make changes. When you are going to make changes, is it what we have done in that question as such? Is it right? When we have taken that into consideration, 2,500. Is it right? This is the one of the questions. Is it one of the example? Is it in that example we have done for 2001 and we have done for 2000. Is it right? We have what we have done? We have added 2,500 and we have deducted 2,500. Fine. We have deducted for this. Is it right? Now, subsequently, what happens? Which profits are affecting? The profits for 2001 is affected. The profits of 2000 is not affected. We have taken the same profits, 11,200, something like that. Is it right? We have taken the same profits of 11,200. But the changes has been done for which year? The changes has been done for the current. We cannot do any changes for the previous year. We have to do changes for the current year only. Or we have to change for the next year also we cannot do. Is it right? Whatever the changes we are going to do, this is what we have done in the example 1 which we have done. By changing the current year figures but not the previous year figures. We cannot change previous year figures. Is that? By changing the current year figures and the previous year figures, we cannot do this. Is that? We cannot do this. No alteration of any figures, but no, we have to change. Neither alteration of any figures nor disclosure, no. If it is material, if the amount is material, it has to be disclosed. This is one of the clauses. Is that? If the amount is material, it has to be disclosed. That is one of the clauses. What we have to do? We have to do changes only for the current year. Which one of the following statement regarding IFRS fair value measurement? What is the fair value measurement? How it has to be done? Is it? Inputs level are likely to be used without adjustments. What is the fair value? Value as on time of sale, or what they say, transfer of liability. This is a value at the time of sale or the transfer of liability. We see, the rule of fair value says that it will make some adjustments. Is right? Without adjustments, it will never happen. Input comprise quoted prices in active markets for identical assets. No identical assets. There's no quoted prices. Is right? The prices are going to be the realized prices. Is right? Realized values as such. Fair value means what is the value at the time of sale. Is it right? It will change from time to time. Is it right? There will no identical assets. Every asset will have a different characteristics. Got my point? Every asset will have a different. 100 cows, $1,000 each. Is it right? 105 cows, it has to be $1,000 only. Is it right? If you go by like that. If you go by like that, it should be 1,000. No, it's not 1,000. It is more than that. Again, this will not work. Level 2 inputs may include quoted prices for similar but not identical. Is that? No, is that? It's, see, that's what it's not a similar also. Is it right? It has to be. It has to be the best way of getting the things into what is the best price. I can say put like this. Is it right? Level 3 inputs are based on the best information available to market participants and therefore regarded as the most reliable evidence of the fair value. Means when you are talking about the things, what is the most reliable, how is the best information. See, you are selling your asset. When you sell the asset, you will sell the asset at the best of the best price. That best of the best price is otherwise called as a fair value. and fine.